So a lot of these orders are made up of algorithmic orders. So it's computer programs that have been coded, formatted by math geniuses and computer programmers to ideally price and hold orders in the market. 70%, probably more now, but 70% was the last that I heard. 70% of the orders and the transactions in the markets now are electronic. So they come from computer programs rather than somebody sitting and pressing to buy and pressing to sell and phoning the broker up and submitting orders through the broker that way. So it's a huge chunk of volume. Now these there's no I'm unbiased in the topic at the moment with regards to the computer programs. But what we tend to have is when we see large orders coming into the market, so large physical orders, such as a bank or a hedge fund with 1,000 contracts to fill, what we typically see is the machines uh, following or trading off of the momentum of large orders. So for every large order that we do see, so we could have a 500 lot clip come in and move cable, the price of cable on the CME futures 20 pips, for example, we may see a 10 pip or a 20 ticks spike in price. On the back of that, we may also see a further extension because of the machine pressure, the algorithmic pressure on price. So if we have a large order come in to sell, the default setting on the machines and the programs is to also sell. So what obviously they do that by removing the bids in their market, so that they're constantly promoting or providing a bid and an offer for people to trade. They're largely considered liquidity providers. What they do when they see large orders coming in is remove the bids. So we see a large offer come in, either a resting or a market order. The bids are then pulled, and machine selling is what we call forced selling or forced buying, if it was the other way around. And that further pushes the price extension to a point where we become overdone, which is why we get a lot of these wicks running through stop levels and uh, sort of particular price points. So we'll look at the daily time frame for the cable. So knowing that we have large orders coming in, what we actually see is inside each one of these daily price movements, we get the machines false selling, which further adds to the sell side pressure. So knowing that there's large sell orders coming in, algorithmic programs are removing bids to obviously create that lack of liquidity as well on the buy side. And the default setting, as we mentioned, is to just follow on from large orders coming in, so that the moves are exaggerated largely by machine forced selling. We often see price points traded through because of such things, and until the liquidity returns, meaning until somebody who had a large sell order up the top here or wherever it may be, until a large buy order comes in, those machines will continue to have a thick offer and a wider spread on the bid ask. So their market may be 24.50 offered for 500 for 5 lots and 24.40 bid for 1 lot. So their offers are heavier than their bids, and their bids are further away from the current market price. So again, that grabbing of the liquidity from sell side action has to be exaggerated because the price isn't 50 offered and 49 bid. The price is 50 offered and 40 bid. So anyone selling is selling sort of on an unfair auction, if you like, and the nearest bid that they can find is 10 ticks below the price. When we have huge selling pressure like this, or even huge buying pressure, the market becomes very thin. The spread becomes typically wider, and we see these exaggerated moves.